We're going to look at performing first mortgages and reperforming second mortgages. I've been a note investor for over 15 years. I have experience in all aspects, but my true niche and my true investment strategy is a second mortgage note investor. Buy a lot of non-performers, and I also buy a lot of reperformers. I have about 5 buckets that I buy in. A lot of those buckets are reperforming second mortgages, so that I do have a lot of experience and knowledge that I can share with you. What's a non-disclosure confidentiality agreement? So when you're buying notes, most note sellers will make you sign one. A non-disclosure confidentiality agreement is a legal contract or part of a contract between at least 2 parties that outlines the confidential material, knowledge, or information that the parties wish to share. It will spell out how you need to keep all that borrower and loan information supplied to you private and for personal use. And then I always add this a lot when I'm talking about purchasing assets and when you're doing your due diligence. Remember, never talk directly to a borrower or send someone to the property when you don't own that mortgage note. In my opinion, a major no when you're doing your due diligence to send anyone to the property and bang on the door. If you're getting BPOs or you're getting somebody to do a drive-by, that's fine. But when you don't own it, don't send anybody to the property. So reperforming mortgage note due diligence main items. So when it comes to the loan's borrower and the loan's collateral, the property, we need to review the following information and items. We need to perform our mortgage note due diligence. So item number 1, the note seller's information, reputation, and track record. Number 2, the collateral lien's vesting position and information. Number 3, the collateral property's tax status and homeowner insurance information. Number 4, the collateral property's condition and occupancy status. Number 5, the collateral property's value and your loan's equity position. What's covering your equity in your loan on the property. Number 6, the collateral property's borrower's credit report status. Number 7, the collateral property's borrower's bankruptcy status. Number 8, the collateral file documents, loan modification, loans accounting and payment history, the seasoning on the loan. And number 9, the loan's real cost and fees. Recording your assignment, loan servicing fees. If you have it with IRA custodian, what are those fees? There's some items on here that you'll look at a little differently with first mortgages and you'll look at a little differently with seconds, but we want to go through all of it with both, and we want to determine what we need to look into a little more with seconds compared to first. So they are the 9. So number 1, note seller's information, reputation, and track record. It's about knowing who you're doing business with, knowing what you're purchasing and how much you're purchasing that loan for. And when you say you're going to execute and fund a transaction, you want to do that on time. There's a lot of exceptions that we may find in our due diligence period, and that's okay. We share that information. Maybe we'll get a discount, and it's okay if we back out as long as we have that information and we supply that to the note seller. As you start maneuvering your way through the business, you're going to find people that are credible and reputable. Not the best deals all the time, but we all know them. We've all done business with them. It's easy to do your due diligence on with people in the group, with people in the network by just Googling the note seller's name. And I know Rob does a good job of supplying the professional members with the spreadsheets after notes have been purchased so you can see who won the bids, what the highest bids are compared to their bid. But with that said, you want to start understanding all those loan sellers' spreadsheets. And there might be some information on there that doesn't really determine if you're going to buy the loan or not, and you may not need that information. So I know when I get spreadsheets a lot, I'll delete columns that don't supply much information for me. There's a lot of columns in there, and I want to really kind of narrow it down to the numbers that I really want to see. So that's different for everybody. So as you start going through and you're buying more and you're seeing more spreadsheets, you can really determine on what information is useful and what information is good to have, but it's not going to help you to determine what you want to buy this note at. So just some stuff to think about. The next, we have 3 of the categories together: the collateral lien's vesting position and information, property's tax status, homeowner insurance info, and the property's condition and occupancy status. Reperforming is definitely different than non-performing. I know with non-performing first mortgages, it's more about the property, whereas with non-performing seconds, it's more about the borrower. We're talking about reperforming reperforming notes. So we're buying notes that have already been resolved. So as much as it's about the property with first mortgage reperforming first, the homeowner's paying. So some things may be a little different. If it's a reperforming first mortgage, maybe the taxes are current. Whereas if it's a non-performing first mortgage, majority of the time the taxes are not current. Same thing with the insurance. If it's a reperforming first mortgage note, there's a good chance that there's a current insurance policy on it because whoever resolved it made sure the homeowner got legitimate homeowner's insurance. So when you're doing your due diligence, you always want to be aware of the property's condition, the current homeowner's insurance situation, and the status of the taxes. There are multiple reports that can be very helpful when we do our due diligence, and there's many sites that we can go to. Majority of these reports cost money, but majority of these companies have an application process that you need to go through to access these reports. A good note seller, especially when they're selling a reperforming mortgage note, should supply title report, a credit report to supply the most information that they can to sell their asset at top dollar. And if they don't, start poking around in your network and see who can access these reports. There's a lot of good people in this business, and as you form relationships, there's a lot of good note investors that won't have a problem helping you out as long as you pay for the reports. So one of the main reports that we look at, both with non-performing and reperforming mortgage notes, is the title report. The title report's an important document that provides a detailed overview of the property's legal status. It identifies the current owner on the property, which is essential for us confirming that the seller has the right to sell it. Additionally, the report will highlight any liens or encumbrances. A lien is a legal claim against the property, often due to unpaid debts, which would complicate the sale if you're not aware of it. One time, I had a client buy a reperforming mortgage note off of somebody that wasn't reputable and credible note buyer. But I learned my lesson on this deal. There wasn't a title report involved, and about 6 months after receiving payments, we were getting information that the property was going to tax sale. So the homeowner was current on the first and the second, but the taxes were not current. It slipped through my systems and processes, and it will not happen again. This will help avoid surprises that could arise after you purchase the property. And you'll see I put a company's name and their website, who other note investors use. There's a lot of services out there that have investigation software and batch skip tracing. These are just some that we use, ones that I like and ones that I trust. You got property tax information. How much will a tax sale reduce your lien? So if it goes to tax sale and it just sells for the tax sale, the first and the second get wiped. This was actually in Ohio where there's 2 sales, and then one sale just includes the tax sale, and then there's a second sale if it doesn't sell. But if it's sold at tax sale, just for the tax amount, the first and second gets wiped. But if there was an overage, meaning they bought it for more knowing that it was subject to other loans, it gets confusing. But if bid runs up and there's an overage, whatever's left goes to the first gets paid off, and then it will come to the second. But definitely a situation we did not like. We got aggressive on it. We contacted the homeowner, we contacted the first mortgage lender, and the homeowner actually reinstated the tax liens and paid off the taxes. That's how that one was resolved. Property tax info, all county tax assessment offices in that specific county you can go to get information. All those counties have created a neutral website called Neutral Online Public Records. That's a good site that has a lot of tax assessment and tax information on it. It's kind of a little of a watered down version of the title report, but works really well when you're purchasing a note. I'm okay with O&E reports when I purchase, but there's nothing as good as a title report. TLO reports, that's TransUnion. They offer all kinds of reports. You do need to be a paid member, and they do have an application process, but they have a lot of cool reports. You can get borrower reports, credit reports, asset reports, foreclosure reports, property reports, criminal background reports. A lot of good information with TLO, TransUnion. Data tree reports, they're property data reports. They're quick reports on spreadsheets that let you know if items are unsecured or secured, and they let you know other lien information, and it's just a quick pull. A lot of these companies cater to different investors depending on the bulk or depending on what they're ordering. So even if you're not going to use them, I think they're worth a call to figure out what vendors charge, what their process is, and if there is a fit, if you could use them or not. The collateral property's condition and occupancy status, and the collateral property's value and your loan's equity position. With the lien status and the occupancy status, sometimes you can find that out from other reports. Sometimes you can find out the occupancy status on the credit report. Sometimes you can find them out on those TLO reports. So with fair market value, I think this is probably, besides the taxes, the insurance, and the condition of the property, which we're talking about here. When you're looking at the value, when you're buying a reperforming second compared to a reperforming first, I think it's going to be different. I think with the first, you're probably going to want to order a BPO, broker's price opinion, and it's going to give you a better idea of a fair market value than the free sites. Because as a second mortgage note investor, I will usually just Google 4 or 5 of the free sites, which are like Zillow, Appraisal, Redfin, Trulula, a realtor, foreclosure, just to give me an average fair market value. And I'm okay with that. Now, everybody is different. You're going to need to determine what you're comfortable with. I'm okay with the free sites. And like I said, I buy a lot of reperforming seconds. So depending on what you're buying, you determine that. But whatever you determine, you definitely want to have an idea what the value of that property is, especially with the reperforming. Non-performing is different because you may end up with the property and you want to have a better idea of the condition of the property. Usually what I'll do when I'm buying reperforming is just always Google the borrower's name or address and see if there's any red flags that pop up. Collateral properties borrower's credit report status, and collateral properties borrower's bankruptcy status. Now, as a second mortgage note investor, both with non-performing and reperforming mortgage notes, I will say this is probably my biggest due diligence item that I'm looking at. I'm looking at the credit report and I'm looking at the bankruptcy status. Even with a reperforming mortgage note, I want to know if they are Chapter 7 bankruptcy discharge, and I do want to know if they've been dismissed or discharged from a Chapter 13 bankruptcy. I just want to have that information. It gives me an idea of what the past has looked like. So the credit report, we're looking at the borrower information, and I put first mortgage information depending on what you're looking at. I think this also relates a lot to reperforming first. Just kick out what I say about the first mortgage information on the credit report. So a credit report should be supplied by a note seller when you're doing your due diligence. I rarely have ever bought a reperforming mortgage note without a credit report. If not, a lot of people use CoreLogic. Other people use TransUnion, TLO, but especially as a second mortgage note investor, it's really important that you learn what the credit report is and what the information means on the credit report. And we kind of have to sort through the bad and the good and really pull out the information that we need to determine if we're buying this note or not. Because the reality is all these borrowers have been through something, even if these are reperforming notes. So a lot of times the credit scores aren't great. So what am I looking at on a credit report? I'm looking at the borrower's credit score. I'm looking at the borrower's name. I'm making sure the Social Security and the birth date matches up with the loan that I'm buying. Some credit reports will give you numerous addresses of the properties that they own, and it will show you on the side the length of time that they've been in the property. So sometimes you could determine if it's owner occupied or if this is a rental by just looking at the credit report. The amount of debt, the more pages of the credit report, the more debt, the more transactions that they've encountered. I know note investors that won't buy any notes if the credit report's 8 pages or more. Doesn't matter if it's a non-performer or reperformer, it needs to be 7 or less on the credit report for them to buy it. Everybody's different. It'll show you judgments and other tax liens. But as a second mortgage note investor, one of the main reasons I like the credit report is I can get the first mortgage information and status off the credit report. The note seller should have told me that the first mortgage balance is current and what the amount of the first mortgage principal balance is, but it's up to me to confirm if it's current or not. So looking on the credit report, a lot of times I can confirm what the note seller told me. I can see if it's current. I can see when the last payment was made or the next payment's due. I can see the loan balance. Sometimes it'll tell me the monthly payment. Sometimes it'll tell me the terms. And sometimes it will actually tell me if it was modified. And sometimes we'll know the lender that has it from the credit report. It'll mention the first mortgage lender on the title report, but on the credit report, it may give you the servicer's name of where the loan is actually at. Some give you the account number, some don't. But what I usually will do is I will get the information off the credit report. I will then Google the lender/servicer's name, and I will get the 800 phone number, and I will call the automated phone system to access the first mortgage loan balance information, and I will check the status of the mortgage. I never want to talk to an operator or give false information over the phone. I just stick to the automated phone system. If someone answers, I just hang up. To access the phone system, majority of the time, you will need the account loan number or the borrower's social security number and the property zip code. So even if I don't have the account's loan number and I have the right servicer and the right 800 number, I can access the account through the automated system with the borrower's social and the property zip code. If this is a secured lien that I'm doing my due diligence on and the first mortgage information is not on the credit report and I'm buying that reperforming second mortgage, majority of the time it's because the borrower was discharged from Chapter 7 bankruptcy and it's just not reporting back to the credit report anymore. Collateral properties borrowers bankruptcy status. No matter what I'm looking to buy, if it's a reperforming or a non-performing mortgage note, Pacer is a bankruptcy site online. It's public access to court electronic records, which is Pacer. The service provides electronic public access to federal court records. You need to set up an account. It has every bankruptcy case ever filed. I use it all the time as an asset manager and as a note investor. If they did have prior bankruptcy cases, you can find all the information you want about it. A lot of good information in there. So if you're not using Pacer, definitely get used to it and get comfortable with it. So let's just do a quick review on bankruptcy. If a borrower or homeowner filed Chapter 7 bankruptcy, that means discharge of the debt. They are not personally liable for the mortgage anymore, but the lien still exists on the property. When they sign that loan mod on that reperforming mortgage note, there's some language in there that says just that. It just means the homeowners got rid of a lot of their debt that they're liable for. They're just moving forward with a new plate. Most of them are still in the existing property, and if they want to stay in that property, they need to pay on the existing lien against the property. Chapter 13 bankruptcy. This was reorganization of the debt. Borrowers are put into a 3 to 5 year bankruptcy plan. When they pay off their bankruptcy payment plan in 3 to 5 years, they get discharged from the bankruptcy for completing the plan. And majority of the time in Chapter 13, they don't pay off the mortgage inside the bankruptcy plan. They will usually still owe on the loan after the bankruptcy plan. Usually in the bankruptcy plan, they're cleaning up on the arrears that they owed. So it's more to deal with non-performing notes, but I've bought in plenty of reperforming notes inside bankruptcy where the homeowner and the lender did the loan mod outside the bankruptcy plan. The lender's getting pre-petition arrears through the bankruptcy plan. I'm getting paid on the loan mod outside the plan. But usually when they're inside their bankruptcy plan in Chapter 13, it's called pre-petition arrears. It's the arrears that they owe from the time that they went delinquent to when they filed the bankruptcy, and the post-petition arrears are just getting caught up inside the bankruptcy plan. So that is bankruptcy in a nutshell. Collateral file documents, loan modification, and loan payment history, especially with all mortgage notes, but the loan modification and the loan payment history are very important when I'm looking at reperforming mortgage notes. So I want to see images of all the collateral file documents, including the current loan modification that's in place, the loan's accounting and payment history from the loan servicer before I agree to a purchase price. Maybe I agree to the price, but before I actually sign the agreement, I need to see all of that. The collateral file documents, I want to see the recorded mortgage, the original promissory note with the allonges and the endorsement chain, the recorded assignment of mortgage chain, the allonge and assignment that's coming to me, even if it's not executed yet. These aren't always included, but are nice to have, right? The original title insurance policy and all the original loan documents from the actual original loan transaction with Rob's trade desk. The majority of the loans that are coming out of there, you do get this stuff in it, depending on who the seller is. The loan modification agreement. What is the loan modification agreement? How's it spelled out? How's it protect me? How does it protect the homeowner? And I put package, right? So when I buy a reperforming mortgage note, that investor worked this thing out before. And when they modified it, what was the down payment that homeowner made? The bigger the down payment, the more skin in the game for the homeowner, and the more likely that reperforming mortgage note will move forward smoothly, right? If a homeowner paid $1,000 up front or $10,000 has more skin in the game. I will buy both with $1,000 payment and a $10,000 payment. It will just affect on how I put my bid in on that note. So supporting loan mod documents, no matter what you're buying, I want to see the homeowner's identification, a copy of the license. I'll have them sign a W-9 form, IRS tax form. I will have them sign and supply homeowner's insurance information and the homeowner's insurance declaration policies declaration page. I really want to know that I'm listed as loss payee and that I'm being protected protected with insurance coverage on my reperforming mortgage note. Very important to me. If I'm buying a second, in that package, I want a third-party authorization form giving me access to talk to the first mortgage lender or servicer. I want the homeowner to supply a copy of their last first mortgage statement so that I can see that it's current. Not all note sellers supply that, but I do when I sell notes, and some note sellers do. And then the last thing is the accounting and the payment history. Most of us have these reperforming mortgage notes with a loan servicer. It's real easy to go in and print out the loan's accounting, the loan history, the payment history, everything that you need to see on the loan. And one of the most important things we're looking for is the seasoning on the loan. How many payments has this homeowner made on the loan? If they made 48 monthly payments, have all 48 monthly payments been made on time? Gives you a good overview of the loan. So I think that touches on a lot of that stuff. Our loans, real costs, fees, assignment, recording costs, loan servicing costs, and self-directed IRA costs if you have them with a custodian. So everybody's different on where they have their loans, the cost that they're looking at, but these are just a few that I look at. Depending on the county and where I need to record my assignment, counties are different. Some counties are about $20 to record an assignment, and some New York and PA counties are close to about $250 an assignment. So it's a little different, but the costs start adding up. A loan setup cost, your loan servicing cost. You definitely want to understand your setup cost with loan servicers and your self-directed IRA custodians. They all charge monthly fees and they all charge fees to set up the loan. So I know at least with servicing setup costs, I use FCI Lender Services a lot with my reperforming mortgage notes. It's $75 to set up and they charge me $20 a month servicing fee, which comes directly out of the homeowner's monthly payment. So the homeowner makes the payment, and when they send me the monthly payment, it's $20 less than what the homeowner sent in. And then self-directed IRA custodians, they're all different. Usually they will have a setup fee and then they have their yearly accounting fees at the end of the year. And then the last thing that I want to mention, and I'm always aware of when I'm buying reperforming seconds or reperforming first, it does not matter. I just want to understand the cost of legal and the length of foreclosure, just in case it goes non-performing and I need to take legal action. Every investor will be different how they work that into their cost when they bid on notes. I will show you a little bit what I do and how I make up for costs when I'm putting my bids in on reperforming mortgage notes. So they are the 9 items that I'm looking for. If I was looking at an asset, I just reviewed those 9 items and everything that we talked about. Purchasing reperforming mortgage notes, but I need to talk about this with due diligence because I'll give you an idea of how I pay less for a mortgage note or if I will pay more for a mortgage note. A lot of the times it will have to do with the note seller, the loan modification package that I'm getting, the seasoning, the supporting documents, the down payment that was made on the loan modification, equity position covering my reperforming second. There are a lot of good variables. So when those variables are all good, I will pay less for a reperforming. I will pay more and I will take a less yield for a reperforming mortgage note, whereas compared to maybe all those variables aren't great and I want a higher yield, so I'm going to pay less for this particular mortgage note. So when I'm purchasing reperforming mortgage notes, it's based on the yield that the note buyer wants, based on the yield that I want, and it's based on the yield that the note seller is willing to sell it at. What I see in today's marketplace on yields on reperforming mortgage notes are usually between 8 to 14% yield. You can buy them for more, you can sell them for more, you can buy them for less. It's just an average of what I see and where I'm at. So yield is based on time value of money, which is TVM, which is a core corporate finance concept that states that money available now is worth more than the same amount in the future due to its potential earning capacity today, right? With reperforming mortgage notes, you're getting a monthly payment back every month, which consists of principal and interest. But the bottom line is after 12 months of payments, you now have more money that you can reinvest, which is what the concept of TVM basically is. So to determine yield and purchase price, I use the 10BII financial calculator. The app on the phone cost around $5.99. When I was a note investor, very early on, I had a seasoned note investor tell me, when you start playing with the top 5 buttons on the calculator, that is when you will know that you became a seasoned note investor. I really never knew what the guy was talking about until I owned a portfolio of reperforming mortgage notes, and I started selling what are called note partials. And I sell a lot of note partials off my portfolio. And when I really dug into this app and the top 5 buttons, it all clicked on what that note investor shared with me that day. And I understand exactly what he's talking about. The top 5 buttons equal the TVM, the time value of money formula. You will need the following information to determine your purchase price, which is button number 3, present value on a reperforming mortgage note. So button number 1 is the number of monthly payments that I'm purchasing. So this note seller is selling 200 loan payments. So I put 200 in the number button and I hit the number button. Button number 2, what is my yield when I'm buying this note? Not the interest rate, but my yield that I want. I like to buy at 12% yield is where I like to buy at. That is my comfort level. I've bought less and I've bought more. Obviously, more is better for us, the yield, but sometimes the higher yield, I'm buying it at less of a discount and maybe I need to revisit it sometime. There's a lot of variables. So I'm putting in 12% is the yield that I want and I hit the enter button. So I'm skipping that middle one, which is reading 0 right now. And I want button number 4, which is the monthly loan payment amount that I'm going to get. So when I add these, I put my monthly payment in as a negative number. The payment in or what you're purchasing at, one needs to be a negative, one needs to be a positive. So for me, I do the monthly payment as a negative number because it's a payment that's coming out to me. Present value, I leave at a positive number. You could do it either way. One's got to be a negative, one's got to be a positive. So in this scenario, the actual loan payment is $507. When I calculate my yield and I want to know my true cost, I will subtract that $20 a month from my servicing fee. So the actual note payment that I see is not $507. It's actually $487, which will affect the yield big time. So the monthly payment to me is $487. I put the negative on it, I calculate it, and then I'm out to this last section, which is button number 5. So a lot of times with these, button number 5 you're not using, it's just at 0. But if you're buying a reperforming note and there's a deferred balance, not a balloon, but a deferred balance like deferred arrears or deferred principal, separate from the unpaid amortized principal balance that's sitting on the back of the loan. Maybe it's 15 grand deferred amount. You can put that in the FV button for present value, future value. But once again, do that as a negative number like the monthly payment if there's a deferred balance. If there's not a deferred balance, like I said, just put it in as a 0. And if I did this on my financial calculator and PV was reading 0 and I hit it, it would calculate this mortgage note and tell me that I'd be comfortable purchasing this mortgage note at $42,000, $43.37. So that's a 12% yield if I get all monthly payments. Or if a homeowner pays off beforehand, I get the money back. It changes my yield, but it gives me my money back to invest so I can do more stuff. So one way is that I will buffer my purchase price is with the number of payments made. So say on a loan like this, I'm buying 200 loan payments. I may take off 12 monthly mortgage payments right off the top and just calculate 188 monthly payments. And let's just say that the loan mod package isn't great. The loan mod's okay. There's not a lot of supporting documents. I may bump my yield up to 13 or 14 and then calculate it that way. Start figuring out what makes sense for you and how you can add your buffers in. You know, if I'm buying a mortgage note that has 60 payments left compared to a mortgage note that has 350 payments left, that's 290 payments. So maybe I'm putting in a lot bigger of a buffer on 290 payments than I am on 60 payments. What could affect that also is if the person selling it to me received 10 years of payments, I'll buy it at a lower yield. If they just received 1 or 6 months of payments, you know, maybe I want a higher yield because there's not a lot of seasoning. What does deferred balance mean? How does it get paid in a balloon? Confusing since it isn't amortized. So a lot of us non-performing note investors, when we modify a loan, a homeowner has what's called the unpaid principal loan balance, and they also have what are called the owed arrearage. The owed arrearage are like the owed interest and the late fees that they owe from not making a payment on that non-performing loan. Let's just say it was a 10-year period. So let's just say in this scenario, the loan balance is 40,000, which is the unpaid principal balance, and then there's $20,000 of arrearage, which is owed interest and late fees from when you were not paying on the loan. So when I go to modify this with the borrower, investors can do it two different ways. They can modify all $60,000 of it, the 40 grand of the loan balance and the 20 grand of arrears, all into one new loan balance, and amortize that loan balance, and a homeowner can pay that back off over their monthly payment plan. And when they're done, they're done. Now, what happens sometimes with these homeowners is if I rolled it all into 60 grand and I tried to put a monthly payment on that, I may have to go with a lower interest rate so I can make it a monthly payment that they can afford. So in this scenario, I will just amortize the 40 grand, which will give me a higher interest rate. And sometimes it'll give me the same monthly payment that I was looking for on that 60 grand with a lower interest rate. So here what I'm doing is I'm getting a higher interest rate on the 40 grand and I'm deferring that 20 grand of owed arrears to the back of the loan. You can call it whatever you want. Owed arrears, the owed balance. How I determine them is I call one is the amortized principal loan balance, and the other one is the non-amortized interest loan balance. I put instructions under each of these sections in my loan mod, real clear on what I'm doing. They know that their monthly payment every month is on the amortized loan balance of a certain amount. They know they have a certain amount that they owe when the loan is paid in full. That amount, we're not charging them any interest or any late fees on. They're not required to make any monthly payments. That amount is due in full when they pay that $40,000 loan balance off. So that is that. When you hear the word balloon means, let's go back to that example when I say we rolled everything into 60 grand and we modified that loan with a homeowner. And the homeowner's paying back every month on that 60 grand. We have no money at the end, nothing deferred, no deferred balance. It's just a 60 grand that they're going to pay in full. When I amortize that 60 grand, that may be a 20-year amortization loan schedule. Some investors will put a balloon in there, which means in 5 years, there's going to be a balloon that they owe, which means that balloon is based off a 20-year amortization schedule. So they would have paid on that loan for 5 years. There's a new loan balance, and that's what the balloon is. The balloon is the new loan balance at that time. And when they pay that balloon off, they're done with the loan completely.
So let's say they're behind on their taxes and they're not going to pay it, but you have a lien and you do a corporate advance. Is that like another loan modification or like a second lien?
Every state and county is different on what they allow for corporate advances. So when we use attorneys in this business, their invoices will let you know if it's a recoverable lender expense or a non-recoverable expense. I don't do this, but I do know other investors that do include some due diligence items. The fees that they pay for reports, they include in that lender recoverable. A lot of times what we'll do is we'll just ask the loan servicer or the attorney that we're dealing if they have any input on that. But most of the recoverable lender expenses that we deal with from foreclosure, we get them from the attorney and we just include them in our numbers. So that example I used with that $40,000 note, that $20,000 could have been 8 grand of owed interest, 2 grand of late fees, and 10 grand of owed recoverable lender expenses.
Is taxes recoverable?
Yes, if you reinstate taxes, a lot of us will run it through our servicers to pay. I've done that in the past. I've done it on my own too. Any way you can run it where you have more data backing exactly what you did, invoice, any information you can put into your records, I think it's all good. Like I have a lot of reperforming mortgage notes and they all hiccup. So my policy is after 90 days, if they don't get called up or I don't hear from them, I'll send a demand letter out. And that demand letter I can add to recoverable expenses. They got to pay the expense for the demand letter on top of any other payments to reinstate it. Usually when I get to this stage, I'm not doing any more modification unless I didn't originally modify it and I'm modifying it again to put it into something better. It's back on them and they just need to reinstate their reperforming mortgage note.